RTP JAN-26 for CA final DT. Very beautiful RTP released by ICI. Not just covering too many of amendments, but very complex and trickier points all at one place. A must-do RTP that you must not miss before examination. So, hello everybody, I am your friend CA Rahul Satija, brought up this video to tell you every important detail and solve RTP along with you for January 26. If you have never subscribed to this channel, do subscribe it right now by clicking on that subscribe button. Also, do like the video if you are loving our content. Also, comment down your experience and what else videos you want on this channel. Okay, so we can start off with the video. First of all, we need to understand that for your Jan 26 DT attempt, whatever amendments that have come up to 30th June 2025 are only applicable. First and the foremost thing. Second thing, which Finance Act is applicable for your attempt is Finance Act 2024 is only applicable. Very important, very basic thing. Considered, sir, understood these things. We are already aware of these things. You can just start with MCQs. Need not to worry. Need not to worry. Starting off with case scenario 1. See, if you have not covered the amendment portion, I have uploaded entire amendment videos in English also. Whatever amendments, statutory updates that ICI has come for September or Jan 26, I have uploaded those videos separately in proper full English. You can refer those amendment videos. If you have not referred, whatever the amendments that are relevant to solve these RTPs, I will be briefing out in this video only. So you need not to worry about it at all. So question number 1, what this question suggests. Mr. Rohan Mehta is a property dealer who is engaged in the business of constructing apartments. Mr. Rohan is into construction business, need not to worry. A search under section 132 is took place, conducted, started on 10th December 2025 and it lasted up to 18th December 2024. Started on 10 December and concluded on 18th December 2024. Sir, what is the date of conclusion of search? Ultimately, 18th December is important date for us. Date of conclusion of search is the most important date to which our block period continues. The following facts were discovered during the search proceedings. Cryptocurrencies were identified. Oh my god, such a fraudulent person. Rohan, 50 lakh rupees cryptocurrencies. Cheat. Jewelry worth rupees 30 lakh. Oh my god, too many fraudster person. Too much fraudster. Out of this, Rohan could explain only 20 lakh worth of crypto. That means out of this 50 lakh, he can explain 20 now. So 30 lakh is only the unexplained. He can explain 10 lakh jewelries. Okay, 10 lakh jewelries. So out of that, 20 lakh is still unexplained jewelry now. 20 lakh is still unexplained. Okay, sir, got it. Further, books of accounts revealed that unexplained expenditure of 15 lakh incurred during financial year 2023. Oh my god. Apart from these two, 15 lakh is additional unexplained income. From foreign travel of the family members, no proper source was explained. Loose papers indicate receipts of 40 lakh in cash for which no sale of for sale of flats. This amount was not recorded. For 40 lakh worth of sale, he has not recorded any rupee in the book. That means this 40 lakh rupees receipt in cash is also unexplained income. It is also unexplained income. Can you all calculate how much unexplained income has been? Sir, 105 lakh. 105 lakh, or I should say 1.05 crore rupees is the unexplained income of Mr. Rohan. Okay. It has come to the notice of assessing officer that assessment for 23 and 24 was pending under section 143(3) on the date of initiation of search. Assessing officer issued notice for 158 BC since search has concluded after 1st October 2024. So block assessment proceedings will be taking place in this case. Sir, got it. For furnishing of return. See, as soon as 158 BC is furnished, assessee is required to furnish ROI within 60 days. Got it, sir. In this case also, assessee has been asked to file ROI within 60 days. However, Rohan Mehta did not furnish the return of income, did only furnish after 60 days. Like other Indians, he furnished return late only. Assessing officer, after considering the evidences, determined the total income of 1.05. 1.05 as we identified, assessing officer did the same work. And also proceeded to levy of taxes at the rate of at the applicable tax rates along with surcharge and education cess. Assessing officer charged tax rate that is applicable to slab person. Whatever the slab rate that we have studied for default tax regime, has been charged by assessing officer. Whether assessing officer has done correct or not, right answer is no. Now, a person who is being assessed under this block assessment will be charged at the rate of 60% of taxes. Slab rate is not applicable to these people. 60% tax rate is applicable. He was also levied 2% interest on undisclosed income of every month. 2% interest. Are Baba, this is not done. Only 1.5% interest is applicable to these people. Maximum interest that can be applicable is 1.5% per month and part of the month. Okay. From the period within the expiry of 60 days till the ending of the completion of the assessment under 115 58 BC. Okay, sir, this seems correct. Period is correct. From the end of 60 days till conclusion of assessment. So this is absolutely correct period. On 12th March 2025, Mr. Jeevan and Shyam purchased an apartment from Mr. Rohan Mehta. Okay, Rohan sold the apartment to Mr. Jeevan and Mr. Shyam. Apartment was sold for 70 lakh rupees, each of the person paying 35 lakh each. Perfect. Stamp duty value of the house is 48 lakhs. See, stamp duty value is 48 lakh. It is not relevant. If consideration is higher, then stamp duty value is irrelevant. Got it. The consideration amount of 2 lakh includes 2 lakh towards car parking and 50,000 rupees towards maintenance. See, if 70 lakh is the consideration, out of this is 2 lakh for car parking, 50,000 is for maintenance, and 67.5 lakh rest is for the flat only. So do we have to demarcate? Do we have to distinguish? Right answer is no. Now, whatever payment we are doing for car charges, maintenance, we have to club all these payments to find out the limit of 70 lakh or the consideration. So in this case, demarcation is not relevant. Consideration 70 lakh is only relevant. Perfect. On 20th March 2025, ABC Private Limited bought back 50,000 shares, including 500 shares from Mr. Jeevan at rupees 1250. So Mr. Jeevan had 500 shares and these were bought back at 1250 rupees, which would total to 6,25,000 rupees worth of deemed dividend. If you are aware, as of now, if any company does buyback, so whatever the consideration that shareholders receive on account of buyback is taxable as deemed dividend. These shares were acquired for 200. That means 500 shares acquired for 200 rupees, and that too in 2018. That means Jeevan will have long-term capital loss of rupees 1 lakh rupees. 6 lakhs 25,000 would be deemed dividend and 1 lakh would be long-term capital loss. Every information that has been there, we understood that definition, we understood the relevance of the information. Now let's start question answers. Let's see what question answers actually imply. Whether any tax is required to be deducted on purchase of the apartment by Mr. Jeevan and Shyam. See, Mr. Jeevan is paying 35 lakh rupees, Mr. Shyam is paying 35 lakh rupees. Earlier, we used to have a provision that if individual person is paying less than 50 lakh rupees or consider SDV is less than 50 lakh rupees, no TDS was required under section 194 IA. But with effect from 1st October 2024, there came an amendment whereby it said that it is irrelevant. That if you are paying less than 50 lakh, it is not relevant. If you along with your co-buyers collectively are paying more than 50 lakh rupees, then every of the buyer has to deduct TDS. Now, what amendment has stated, you don't have to see yourself, but you have to see collectively all the buyers. If all the buyers collectively are paying more than 50 lakh rupees, then in that case, everybody has to deduct TDS. So in this case, no tax is not to be required. Wrong point. Yes, tax is to be deducted 1% on the consideration, excluding car parking. No, TDS is to be deducted on car parking also. No tax is required to be deducted since the stamp duty's value is less than 50 lakh rupees. Wrong. Yes, TDS is required to be deducted on car parking and maintenance fees as well. Point number D is absolutely correct answer. Question number 2. What shall be considered as block period for the purpose of 158B? What it says. See, search is concluded on 18 December 2024. Perfect. That means from 1st April 2024 to 18th December 2024 will be first part of the block plus 6 preceding previous years would also be blocked. Right away, starting from assessment year 24-25, 23-24, 22-23, 21-22, 2021 and 19-20. So right away from assessment year 19-20 till assessment year 24-25 plus 1st April to 18th December 2024. This will be our block period. Point number 1, 18-19 seems correct. 24-25 seems correct. 1st April seems correct. Concluded. Array, this question has ended the search on the date of initiation. So this is not the block period. 1819 wrong point. Point number C. 1920 seems correct. 2425 seems correct. 1st April seems correct. 18 December. Yes, this is the correct block period. Item is starting from 1st April of 2018 till 18 December till the date of conclusion of the search. With respect to block assessment, Mr. Rohan Mehta received the following different opinions. Mr. Rohan is getting different opinions. Oh wow. Pending assessment of assessment year 23-24 under section 143.3 on the date of initiation of search shall abate. This seems correct. See, what happens is as soon as your proceedings under 158 BC starts or block assessment starts, whatever the pending assessments that are being undertaken under any section shall stand abate. They shall lose their value. This is correct. Pending assessment shall be completed under that section only. Wrong point. Total income 1.05 crore shall be taxable at normal slab rate. This is also wrong. Total income shall be taxable at that 60% plus surcharge and excess. This is correct. 270A would be applicable. See, whenever any income is being added on account of block assessment, you are not charged penalty under section 270A. No misreporting and underreporting is assumed in case of block assessments. This point is wrong. Our answer would be first point and fourth point. Two of the options are correct, and option number C suggests this answer. Simple point, yes sir. Whether interest levied by assessing officer on undisclosed income is correct. See, interest would be charged for 1.5% per month from expiry of 60 days. From the next day on which a due date for ROI was held. So after the expiry of 60 days till completion of assessment, that is the period for which interest should be charged. Interest at the rate 2%, it is wrong. No, interest at the rate of 1.5% on undisclosed income can be levied for every month and part of the month after the expiry of 60 days, yes, but ending on the completion of assessment. Option number B seems correct. Option number B seems correct. No is wrong. Okay, no, it may no 1% is wrong. 1.5% within expiry of 60 days till the ending of the furnishing of return. See, it is important point to note. Interest is not charged from the date of 60, the end of completion of 60 days till the date of filing of return. Filing of date is not relevant. If you have delayed in filing return under section 158 BC, you will not be charged interest up to the date of ROI. You will be charged interest up to the date of completion of assessment. It is important point. It is important, really, really important point. What are the tax implication of buyback of shares at the hands of Mr. Jeevan? Important point. We already calculated that 6,25,000 would be deemed dividend and 1 lakh will be short-term capital loss. What the answer suggests? Option number B suggests the same answer. That is why option number B is the correct answer. Is it clear to everybody? Very beautiful question based on too many of amendments, too much of amendments. Every question is being based on amendments only that are either applicable for May 25 or September 25 or Jan 26. Whatever amendments that have come for all the attempts now has been covered in these 5 MCQs. Again, the next question that is going to be asked will be based on amendments only. Okay. Case scenario 2, what it suggests. Very beautiful question. If I may ask, I can ask you to rate this question as double star rated. Mr. Amit Verma, a person of Indian origin, resides in Dubai. Person of Indian origin residing in Dubai. Perfect. However, in order to expand his consultancy business, he keeps visiting India frequently. He visits for 90 days, 65 days, 70 days, and 80 days in last 4 preceding financial years. That means for previous year 24-25, nahi. For preceding 4 previous year, he stayed 90 days, 65 days, 70 days, and 80 days. How long he has stayed? 90 days plus 65 plus 70 plus 80. Okay, no issue. That means for 305 days he has stayed. That means wherever we have to see the 365 days condition, that will be violated. Wherever we have to check for 365 days condition, that is being violated. He will never fulfill the second condition. He will never ever fulfill the second condition. Of course, sir, got that point. Okay. He is person of Indian origin. Perfect. He stayed in India for 135 days during previous year 24-25. That means for previous year 24-25, he stayed in India for 135 days. Perfect. Absolutely perfect. During his stay in India, he has earned income of 9 lakh rupees from consultancy business. See, for business income, how much business income he has? 9 lakh. Okay, perfect. Business income he is having 9 lakh. Dividend he is having 2.15 lakh. He is having 2.15 lakh rupees as dividend income and 18 lakh rupees as rental income. Perfect. 18 lakhs. See, whenever we have rental income, can I simply say that only 70% of this rental income would be taxable because 30% standard deduction everybody gets now. So 12.6 lakh would be rental income. Absolutely perfect. From a property in Mumbai. He earned 23 lakh 50,000 rupees as consultancy income from Dubai. Okay. Dubai income is 23.5 lakh. We need to check whether he is resident, so this Dubai income would be taxable. If he is non-resident, then no taxability would arise. He spent 2400 to earn dividend income and 2,50,000 rupees as consultancy for profession in India. See, for dividend income, no expenditure is allowed. Unless that expenditure is towards interest payment, no expenditure would be allowed against dividend income. But sir, for business income, deduction is allowed and this 2.5 lakh would be reduced as business expenditure. Got it, sir. For convenient travel in India, he purchased a car for 11 lakh rupees. Whenever he is purchasing car, that person who is selling the car would be collecting TCS at the rate 1% on this entire 11 lakh. Got it, sir. He also purchased equity shares of Reliance as on 5 May. He purchased shares for 4,25,000 rupees as on 5th May and sold on December 2024 for 6,15,000. That means he sold shares for 615, bought for 425. That means he earned a capital gain of 1,90,000. And since these are Reliance shares, these are listed shares, and he's selling it for less than 12 months. So these are short-term capital gain under 111A. So he would be having short-term capital gain under 111A, that to 1,90,000 rupees. That would be the amount of cap gain. Got it, sir. While collecting the information for filing the income tax return for assessment year 25-26 on 15 July 2025, Mr. Amit Verma noticed that he has failed to claim refund of 10,000 rupees representing tax deducted by his client Mr. Arora and Arora Associates during the previous year 23-24. Then he approached tax consultant Mr. Jagat to file an updated return. Mr. Jagat assured that entire amount can be claimed as updated return. Mr. Amit Verma is paying taxes as per default tax regime. Beautiful, beautiful question. Very beautiful question. Why is it beautiful? First of all, we need to understand the first question is being asked that what is the residential status of Mr. Amit Verma? Let me brief you out. How do we identify? First of all, we need to understand that if any of the person fulfills either of the basic condition, 182 days or 365 days. Is he fulfilling 182 days or 365 days? Right answer is no. He is not fulfilling 182. He is not fulfilling 365 days. He would never fulfill 365 days. In any of the case, he will never fulfill 365 days. So we are sure that he is non-resident. He is non-resident by default. Second thing to be checked, is it a deemed resident? Is he a deemed resident? Section 6(1)(a) specifically states that he can be a deemed resident. He can be a deemed resident. How do we identify? See, deemed resident is a person who is person of Indian origin or Indian citizen who have Indian income more than 15 lakh rupees, taxed nowhere, plus he is not resident of every country. He is not a resident of any country. It is nowhere mentioned now that he is not resident of Dubai. He might be resident now. See, residential status is different thing, and he is not taxed in Dubai. That is different thing. Dubai might tax 0% tax rate, so it is different. He might be resident of Dubai now, so we cannot say that he is a deemed resident. We cannot say that he is a deemed resident. For that matter, we can confidently say that he is a non-resident, and that is the most important aspect of this entire question. If you are wrong in this point now, there is no chance that you will solve this question correctly in latter part. So he is a non-resident in this case. Perfect, sir, got that point. What would be the TCS implication by the car purchased by Mr. Amit? Amit is purchasing car worth rupees 11 lakh rupees. Amit is a non-resident. Non-resident buying a car from resident person, that to 11 lakh rupees. Can you remember 26206C1F? Whereby we have studied that if any person sells the car exceeding 10 lakh, he has to collect a TCS at the rate of 1%, if you are aware. Let me remind you whether this section was applicable to resident or non-resident. Sir, it was resident only. Or sir, it was non-resident. It might be non-resident. Sir, it was resident. It might be for non-resident also. Arey nahi sir, it was resident. Arey Baba, it was nowhere mentioned that it was for resident only. This section is applicable for both the people, for resident and non-resident only. Therefore, TDS, this car company has to collect a TCS at the rate of 1% on this sale car, that to an entire 11 lakh. So no TCS applicable, wrong point. No TDS applicable, wrong point. See, deemed resident. See, deemed resident. No TDS applicable. It is also considering this answer. They are also considering it as deemed resident also. Make sure he is not a deemed resident because it is nowhere mentioned that he is not a resident of Dubai. He might be a resident of Dubai. Who says? Who says he might be a resident of Dubai? Resides in Dubai. See, he resides in Dubai, so he can be a resident of Dubai. If he is a resident of Dubai, then in that case, he can never be a deemed resident of India. Sir, third question. Sir, point number C. Tax is required to be collected on 1 lakh on exceeding 10 lakh. No, sir. On entire 11 lakh, 1% TCS is to be collected. Point number D seems correct. 1% on entire 11 lakh since value of car exceeds 10 lakh. Now, what would be the total income of Mr. Amit? Important point. Will this Dubai income be counted? Right answer is no. Since he's a non-resident, whatever income earned outside India would not be taxed in India. So total income would not include this Dubai income. What would be the total income? Can you all calculate it for me? Whatever the portions that I have highlighted in blue has to be added. And whatever the portion that I have highlighted in red has to be reduced. 9 lakh plus 2 lakh 15,000 plus 12 lakh 60,000 plus 1 lakh 90,000 minus 2 lakh 50,000. That means our total income would be 23 lakh 15,000. This would be our total income. 23 lakh 15,000. This would be our total income. Clear to everybody? Everybody clear this point? 23 lakh 15,000 would be our total income. Next point is the beautiful of all. Calculate the tax liability of Mr. Amit, ignoring TDS, TCS, whatever has been collected or deducted. Only this point is the essence of this entire question. Sir, this business income of 6.5 lakh would be taxed at the rate of slab. Got that. Dividend would be taxed at the rate of slab. Rental income would be taxed at slab. And this STCG, since it is done in December, so it would be taxed at 20%. We would get the answer. I would pray to God that you might get a correct answer, but this would not fetch you right answer. This would not fetch you right answer. Why? Because if any non-resident earns any dividend, it could be taxed at the rate of 20%. Dividend received by non-resident would not be taxed at slab rate. It would be taxed at the rate of 20%. Getting this point? Are you getting this point? Whatever dividend that non-resident earns would be taxed at the rate of 20%. Now calculate this. 6.5 lakh plus 12.6 lakh would be taxed at the rate of slab. It would be 19.1 lakh minus 15 lakh. That means 4.1 lakh would be taxed at the rate of 30% plus 1 lakh 40,000. You can do this formula. You can do this step up. I say allows this thing. 263 is the tax amount. Tax on this dividend and STCG. So 2 lakh 15,000 plus 1 lakh 90,000. This would be taxed at the rate of 20%. That means 81,000. 344 would be tax amount. And still this is not the correct answer. You have to add 4%. Education says 357,760. And still there is an issue. Still there is an issue. Because when you will see the answer, you will see 357,260. It is correct now. But that is not the answer that you got. You got answer 357,760. First option says 260. In a hurry, a student who is tensed might do first option as correct because he sees three initial words as same, last two initials as same, but instead of two, instead of seven, it is two. So you might still do wrong in this question. This tax liability question is very, very, very important. You are not able to understand how important this topic has been, and everything is based on whether you find the residential status as correct or not. If you are not able to find residential status as correct one, this answer would be wrong. This would be wrong. Even the last part might not also be correct. Are you understanding what is the depth of the topics that are being asked in CA final? Question number 10. Actually, everything has been covered in our power batch. Everything has been covered. Need not to worry. वैसे तो. Can Amit file an updated return for financial year 22-23 on 1st 5 April 2025? See, for financial year 22-23, assessment year was 23-24. And we have said that we can file updated return within 2 years from the end of the assessment year. So end of assessment year is 31st March 2024. We still have 2 years time. That means we can file UR up to 31st March 2026. We have this long period. Now, important point here is up to 31st March 2026, we can file updated return. But since he is filing updated return, Mr. Amit is filing updated return for the purpose of claiming TDS credit, a refund of TDS deducted. He is claiming UR for that purpose. Can he do so? Right answer is no. We have already understood that you cannot file updated return for the purpose of your benefit. You can only file updated return for the purpose of department's benefit. So if you want to claim refund, you cannot file UR. So in this case, no, updated return cannot be filed for the purpose of claiming refund, even if 24 months have not been lapsed, and this is the correct option. Did you get this point or not? Are Baba, did you get this point or not? On 2nd June to 2nd April, 2nd Feb 2025, Global Private Limited, just give me a second. Okay. So on 2nd Feb 2025, Global Private Limited buys product from FinTech Solutions. No issue. Try understanding this provision with me. Unit located in IFSC. We have India. We have IFSC located. IFSC unit. In that IFSC, we have FinTech Solutions Private Limited. And we have Global Private Limited, also Indian company. Okay. Global Private Limited is the buyer and the FinTech Solution Private Limited is the seller. Ideally, there is no sales taking place in IFSC. It is only for services, but for some reason they have given this question. Goods purchase sale took place for rupees 63 lakh rupees. Turnover for FinTech in last year is 11.5 crore. That means the seller is having turnover exceeding 10 crore in preceding financial year, and buyer is also having turnover greater than 15 crore. That means he is having turnover of 15 crore. That means buyer can deduct a TDS under section 194Q. He is having turnover exceeding 10 crore. He is also purchasing goods exceeding 50 lakh rupees. So he can deduct TDS under section 194Q. Seller also has turnover in last year exceeding 50 crore, 10 crore. He is also selling goods exceeding 50 lakh rupees to single buyer. Then in that case, he also has to collect a TCS under section 206C1H. Both the sections collide. No, but here is a catch. Ideally, what happens is whenever these two sections collide with each other, we have to give preference to 194Q. But what is happening here? Try understanding this. If we give 194Q a preference, then what would happen? 194Q would deduct a TDS of a person who is located in IFSC, and since this person is not required to pay any taxes, this person is claiming deduction under ATLA, then what would he do of this refund amount? What would he do of this credit? So government in September 25, in ICI in September 25 has clearly notified that government has notified, ICI has issued in its study material that any person who is located in IFSC, you don't have to deduct any TDS of such person. So TDS would not be applicable. So it is responsibility of the person located in IFSC to collect a TCS from this person at the rate of 1.1% on 13 lakh rupees. That is amount exceeding 50 lakh. Whatever the amount that exceeds 50 lakh rupees, TCS has to be collected on that amount. So our answer would be option number A. Last but not the least, very beautiful point. This is, if you have not read this question, if you have not read the provision of this question anywhere in your classes, need not to worry. This is that point only. ABC has got merged with XYZ in pursuant with the High Court order dated 10 August 2026. That means ABC plus XYZ got merged. An order was dated 10th August 2026. Perfect. XYZ has already filed return of income for assessment year 25-26 under section 139(1) before the due date of the order. That means maybe in it is October 2025. XYZ filed the return. XYZ has already filed ROI. On the date of the High Court order, assessment was pending. For this year only assessment was pending. See, XYZ filed the return for which assessment was pending. Assessment was not completed. Assessment was due with AO. Which of the following related to compliance obligation on the successor entity, and what is the fate of the assessment on the merger? Okay. Assessing officer will proceed to complete the assessment as for assessment year 25-26 in line with the order of the reorganization and the modified return. See, let me tell you the brief story. What happens is, see, for example, if I want to merge with another entity, I request merger with companies, ROC. I request merger with High Court. I have to take multiple things into consideration for the merger purpose. This process takes time. If I request for this merger, maybe approval for this merger is received after 2 years, 3 years. In that during that period, what happens is I have to continue filing the return now. Now, if after 3 years I receive the order of the merger 3 days, 3 years back, 3 years prior order, I mean backdated order if I receive. So what happens? As on the date I have already filed the return, my entity is merged in the eyes of the law. What I'm saying is, see, it might happen that on 1st April 2025 I request merger, but I have to do compliance work now. Maybe in 2028 I received a merger order which is dated on this date only. So what would happen? When I am complying the provisions, I am complying as unmerged entity. I am applying it as XYZ. But later on, if merger takes place and merger is backdated, then I have to file everything again. I have to do modified returns. Yes, assessee is required to file modified return in every case. Whenever merger take place and whatever the compliance that he has done as an unmerged entity, he has to file modified return as merged entity. And same compliances are being done by assessing officer also. See, if I was XYZ earlier and I filed return as XYZ earlier, but now since merger took place, I have to modify my return as a merged entity. And assessing officer has to do assessment of this new entity in line with the order of the merger, because earlier entity is not into existence. Now, as merger order came into picture, my old entity is not existing. So assessing officer has to do assessment in line with the new order. Therefore, assessment will be completed in line with the reorganization order. Okay, perfect. XYZ has to furnish modified return within 6 months. Yes, within 6 months you have to file modified return. This date is nowhere mentioned. You can understand this with this point. Pending assessment shall abate. Arey Baba, abatement never take place apart from block assessment. No abatement shall ever take place. XYZ has to furnish the modified return within the 6 months. No, sir, this is not the exact date, but from the end of the month within 6 months you have to do. So point number 1 and point number 2 is correct, which is said by option number C. I hope you understood the MCQs. Let's start question answers, and first of all, triple star rate this question. Why is a triple star rated? Very beautiful question. Very, very, very beautiful question. Shall we start? Arey Baba, shall we start? Shall we start? Have focus. Focus on this way. Focus on my words. What this point says. New motion vehicle is engaged in assembly and manufacturing of automobile parts and auto components in Nagpur. Perfect, Maharashtra. Net profit after debiting and crediting the following items as on for the year ending 31st March 2025 was 8 crore 25 lakh. Perfect. See, before calculating anything, always understand what they are asking. They want you to calculate total income. They want to calculate the tax liability. They want you to calculate as per normal provisions and as per concessional regime also. Suggest which is beneficial. So suggestion is also required, and turnover for 22-23 is nothing but 402 crore. That means 30% would be tax rate for normal regime. Ignore provisions of MAT. Very important point. We have to ignore these provisions. Perfect. So as per normal provisions, got it, sir. Depreciation as per Companies Act 1 crore 80 lakh rupees. Of course, add it down. Add it. Contributed a sum of 10,70,000 rupees to National Reform Party by the way of account paycheck. See, whenever you contribute anything to a political party, first of all, it is disallowed. Then you get deduction under Section 80 GGB, that too under old regime. You get a deduction. First of all, it is disallowed in PGBB, but you get deduction later on. Long-term capital gain of 6,18,000 rupees on sale of listed equity shares as on 19 September 2024, on which security transaction tax was paid at the time of sale. See, first of all, whenever you do any kind of long-term capital gain, it is never a part of PGBP. It is rather a part of capital gain. Under cap gain, it would be LTCG 112A 6,18,000. When you will be required to tax this transaction, this would be taxed at the rate of 12.5% over 1.25 lakh. Sir, got this point. Important point. Loss of 2 lakh rupees on account of hedging contracts entered into for mitigating the losses arising due to fluctuations in foreign currency payments towards imported machinery purchased from Japan for 65 lakh rupees was installed in December 2024. Very beautiful point. It is what it says. You bought a machinery for 75 lakh rupees. You bought that machinery on credit. Because of this credit, you had to pay in later future. And because paying in later future, you had certain foreign exchange losses, certain hedging losses you had. But these losses are on account of acquiring an asset. So whatever losses take place will be added to cost. That means this 2 lakh rupees has to be added back. This 2 lakh is not allowed as deduction, but this will be added back to the cost of asset. An important point, on this 2 lakh you will be getting additional depreciation also. You will be getting depreciation also. On this 2 lakh you have to consider depreciation, and you have to consider additional depreciation also. That we'll do when we are required to calculate the depreciation. Company borrowed funds from State Financial Corporation 75.75 lakh from Andhra Pradesh Industrial Development Corporation. 39.94 lakh from Andhra Pradesh State Financial Corporation. Oh my god. Company had accrued interest of 11 lakh 56,900 rupees on these loans and did not make the payment or record. If you have any outstanding interest towards any of the industrial corporation banks or state development corporation banks, then you have to pay it up to the rate of ROI. Otherwise, it will be disallowed under 43B. However, while restructuring the loan facility, the company converted the interest due on equity shares allotted to financial institutions. Now, this is not old to you. This is new point. Till now, we have studied 3 points. 2 points actually we have studied. If we have any outstanding loan towards bank financial institutions, we have to pay it till the date of ROI. Otherwise, that expenditure will be disallowed. If we convert that loan, if we convert that outstanding interest into a newer loan, will that be allowed? Right answer is it would not be allowed. It would still not be allowed. It is not assumed as payment. But sir, what if that outstanding interest is converted into equity share capital? See, converting into equity share capital would require no payment. If we are converting any of the liability as equity share capital, that means liability is seized off. Now we don't have to pay it ever. So in that case, what would happen? This would amount to payment, and sir, this would be allowed expenditure, and this would be ignored. This would be ignored, and this is not an old point. This has been a part of your judicial updates. I have uploaded a judicial updates video in entire English. This is a case law on which it is said in which it is clearly said that converting outstanding interest into a new loan never amounts to payment, but converting outstanding interest into equity shares amounts to payment. Therefore, it has to be ignored. Very beautiful point. Another, this is brilliant question. The company has borrowed a sum of 866 crore 74 lakh rupees from HDFC Bank as on 1st September June 2024. So what would for the purpose of acquiring the machinery for the same amount, interest on said loan is 10% per annum. Okay, so 6 crore 74 lakh rupees is the amount of loan. Since this loan has been taken on 1st June, so 10% interest would be for 10 months only. So how much interest would be? 6 crore 74 lakh divided by 12 into 10 into 10%. This would be the interest amount for entire year. 56 lakh 16,666. Clear, sir? Clear, sir? Clear, sir? Yes, sir. The interest pertaining to the period on 31st March 2025 remain outstanding and subsequently was paid on 1st October. See, we are paying interest late. We are paying interest late. We are late paying the interest. But sir, that is not the important point in this question. That is not the important point. Mind it. See, important point here is Novo installed the machinery from the borrowed money as on 1st Feb 2024. Let me draw a timeline for you, then you will understand. It is 1st April 2024. You borrowed loan on 1st June 2024. You put to use plant and machinery on 1st Feb 2025. Interest for this period is 56 lakh 16,666. That means this interest is for almost 10 years, 10 months. Yes, sir, this interest is for 10 months. Perfect. Instead of this 10 months, can I simply say that interest for this period till the date loan has been taken and till the date plant and machinery is put to use, this will be added to cost, and this much interest would be disallowed because it is not paid. Overall, can I simply say disallowed interest would be entire 56 lakh only. 56 lakh 16,667. This would be disallowed interest because adding cost would also disallow the interest, and not payment would also attract disallowance. Entire 56 lakh would be disallowed. But out of 56 lakh 16,667, this is interest for 10 months. We have to consider for 8 months how much that would be. Divided by 10 into 8. 44 lakh 44 lakh 93,300. This would be added to cost, and you have to get additional depreciation on these things also. You have to calculate additional depreciation on this. This is the important one, and this is not just a simple point. This has been covered in one of our question of super 100. That too for May 25, that too for September 25. We have covered this question. Similar question has been covered, because if you are considering interest for entire year, if you are considering interest for the entire year, then in that case, now some portion has to be added to our cost of asset, and some portion has to be declared to P&L, what debited to P&L, and whatever the amount that has been debited to P&L will be disallowed. Sir, got that point. On 11 November 2024, company made a payment of 63 lakh towards scientific research. Since you are making payment towards scientific research, this will be disallowed. Allowed, sir. Under old regimes, it is allowed. But whenever you are calculating under 115 BAA, it would be disallowed. It would be disallowed under 115 BAA. Perfect. The company sold auto components worth 18.5 lakh rupees to Zenith, sole proprietor. Okay, this is also another important, beautiful question point. You'll understand this. Why? Sold goods worth rupees 18 lakh 50,000. Perfect. Okay, sir. To Zenith, sole proprietor, on 15th December 2022. On 20th Jan 2024, 11 lakh was written off. 11 lakh were written off as bad debt. Can I say in books of accounts 7 lakh 50,000 are still receivable? Can I say 7 lakh 50,000 are still receivable? Right answer is yes, sir. They are still receivable. Okay, perfect. Sole proprietor passed away. Perfect. Company recovered 9.8 lakh rupees. That means 7.5 lakh were receivable. We received 9 lakh 80,000 rupees. Can I simply say that 2 lakh 30,000 rupees is our bad debt recovered? Can I simply say that this is the bad debt recovered amount? Right answer is yes, sir. This is the bad debt recovered amount in full and final settlement. But sir, this useless dirty fellow accountant, what he did, he entire amount that has been received, he has credited to statement of profit and loss. Blunder, again blunder. What it did? Try analyzing it with me. We were supposed to receive 750. 7 lakh 50,000 we were supposed to receive. But how much did we receive? 930 we received. That means we received excess by 230. We received excess by 230. Yes, try repeating after me. Don't give up. Don't give up. Try repeating after me. We received excess. We received 230. Excess amount we received 230. But this accountant, this fellow Bewakoof accountant, Nalayak accountant, what he did, he credited 980. He credited 980. He should have credited 230, but he credited 980. That means 750. He extra credited. He credited to P&L in extra 750. That means whatever extra that he has credited to P&L would be allowed as deduction now, because excess credit you have done to P&L now. So 750 would be allowed as deduction. 750 has to be reduced while calculating the total income. This is an important point. If you did not get, again hear this audio, you will understand every bit of it. Now, another important point. Oh my God, this is indeed a beautiful, beautiful question. Depreciation calculated as per income tax rules is 1 crore 18 lakh 50,000 rupees. Now, what people would do wrong here is, which includes depreciation, additional depreciation on imported plant and machinery through borrowed fund. That means this 1 crore 18 lakh includes additional depreciation on this 2 lakh. This 1 crore 18 lakh includes depreciation on this cost also. That means whatever calculation we have done now, they have already considered this point and calculated depreciation. Then sir, why did you ask us to do this much hard work? Why did you ask us to do this much hard work? I would say trust the process. Trust the process. I know what I am teaching. I know what is to be understood by students. So trust the process. Trust the process. What I am just saying, try understanding this. Wait for this point. This 1 crore 18 lakh includes every of the expenditure that has been considered. That has been considered is being pointed here. Purchase is not debited to statement of profit and loss. Achha, purchases have not been debited. Purchases. We have purchased goods, but we have not debited the P&L. On 13th March. Okay, 13th March we bought good. Our term agreement says that we have to pay within 30 days. But we are paying on 14 April. That means, are we delaying the payment? Right answer is yes, we are delaying the payment. Are we delaying beyond the agreement? Yes, sir, we are delaying. That means, should this be disallowed under 43BH? Should this be disallowed under 43BH? Right answer is yes, sir, it should be disallowed. But here is a catch. Sir, it is not debited to P&L. We have not even taken deduction of this expenditure. So should this be allowed? Should this be allowed? Should this be allowed? Right answer is yes, this should be allowed. This yes should be, this should be added back. Why, sir? Because under 43 we never say that expense should be debited to P&L. That expense should be paid. Even if certain expenditures are not debited to P&L, if they are not paid, they are still disallowed. For example, GST payable. GST payable, I have taken this example in numerous times in class, that even if GST payable is not paid up to the due of ROI, then it is added back to your income. Similarly, in this case, even in this micro, small, medium enterprises, you have not paid this sum up to the date of ROI, then it shall be added back despite you have not taken deduction of that expenditure. Therefore, 12 lakh would be added to your income. And this point also makes this question more beautiful. And after considering everything, you will get the answer. Let me take you through the solution portion, and you will understand what the solution is. Okay, I'm just highlighting portion. 180, 1 crore 80 lakh added, 1070 added, 2 lakh added, 1 crore 80, 1070, 2 lakh added. Okay, I'll show you what they have done and what we have done. 56 lakh 16,000, 56 lakh 16,667 added. We have also done the same thing. 6 lakh 18,000 reduced, 750 reduced, 118 reduced, 618 reduced, 750 reduced, 180 reduced. Perfect. So this gives us correct. We have got the correct answer. Yes, sir, we got that answer. Now we have long-term capital gains as we credited from there. Deduction we took and we arrived at total income. We arrived at total income. We got the total income. Perfect point. This is perfect pointer. It is. Now, question arises. Are we done with the answer? Right answer is we are not done with the answer. Whatever the cap gain we had, it would be taxed at the rate of 12.5% over 1.25 lakh rupees. This would be tax amount, and remaining income would be taxed at the rate of 30%. Whatever tax amounts turns out to be, we have to add 7% surcharge, we have to add education cess, and this would give us tax liability. And this was not the important part of the question. Important part starts here. Important part starts here. When we have to calculate income as per 115 BAA. An important aspect to this question is, you have to add back the deductions. Whatever income, as per regular provisions, just take that. Whatever scientific contribution you have done, you have to add back. You have to add the additional depreciation. And how much additional depreciation to be added? If you remember, 65 lakh was the plant and machinery brought through Japan. 2 lakh was the amount of losses added to this cost. 67 lakh was the plant and machinery. On this 67 lakh, 10% additional depreciation was taken. Why is it 10%? Why not 20? Because this plant and machinery was used for less than 182 days. Therefore, 670 is added back. Again, the other plant and machinery acquired at 6 crore 74 lakh rupees. If you remember, 6 crore 74 lakh was the plant and machinery that we acquired. On this plant and machinery, 4 crore 44 lakh 93,333 was the amount of interest expenditure that we added back, that we calculated. This would give us 7 crore 18 lakh 93,333. This would be the amount of cost of plant and machinery on which additional depreciation was calculated. We would take 10% of this, and this would be the amount of additional depreciation to be added. This would give us GTI, and we have to charge taxes at the rate of 22%. We have to add 10% surcharge, and we have to add education cess. And since tax calculated as per 115 BAA is lesser now, so we have to go as per 115 BAA. And we also have to write that once exercise cannot be withdrawn, and this would fetch you marks. This is not a simple question. Try understanding this. This is not a simple question. This is not a simple question. Oof. Beautiful question. It was beautiful question. Examine and discuss each of the independent case in the following charitable trust registered under section 12 AB as per the relevant provisions of the Act. No issue. Yashoda Green, a charitable trust having its main objectives as advancement of general public utility, provide electrical scooters to various corporate employees at the Cyber Hub Gurgaon for the daily commutation. With this business activity, it generates 45. Business activities generates 45 lakh worth of revenue, which has been applied for the objects of the general public utility. The entire receipts are 190. See, out of entire receipts 190, 20% can be business receipt, which amounts to 38 lakh can be business receipt. But it is doing 45 lakh of business receipt. That means this business is not allowed. This is not tenable. This activity, this business model is not tenable. Sir, government is not going to give you any kind of exemption for this particular year. Simple question. Samarth, a charitable trust, a vocational training institute. See, whenever you see vocational training institute, it is considered to be an educational institute. It is categorized as educationally charitable purpose. Certificate courses in sewing, handloom weaving, handicraft. It operates a clothing shop in the entrance. The shop derived income of 42 lakh rupees, which is completely applied towards the object. See, whenever you are working as an educational purpose, then any amount of business would work. See, for advancement of GPU, we have 20% limit. Only 20% can be used, 20% can be business receipt. But for any other purpose like education, you can have any amount as a business receipt. But only important thing is you need to have separate books of accounts and you need to have a genuine business corresponding to your charitable activities. It would work. Third thing, Light of Hope, a charitable trust having objects of providing clean drinking water, started its welfare activities in 2019 by providing clean water to some village in Uttar Pradesh. In August 2024, similar object named Water for All was formed by the group of welfare people in Jharkhand. They also provide clean water to villagers of the small scale. Light of Hope offers water to all to merge with them so that they can scale up their benefits and share resources. However, they were concerned about the exit tax levied at the time of merger. See, Light of Hope is one organization who is into drinking water facility, and second organization which is into similar businesses, nothing but water for all. It is into water business. Now, see, we are aware of this amendment also. This was amendment for with Finance Act 2024 only, that if any of the two organizations that have similar objects and they are also registered, if they merge, they would not be leviable for exit tax. If their objects are different and they merge, then in that case, exit tax would be applicable. If objects are similar but one of them is not registered or either of the trusts is not registered, exit tax would be applicable. In that case, exit tax is applicable. But in this case, it is not mentioned whether they are registered or not. In this case, it is nowhere mentioned that they are registered or not. But sir, we are aware. We can assume now if they would be registered, then only this question arises. If they both are registered, then only exit tax arises. Now, if both of them are not registered, no point of exit tax. If one of them is registered, other is not, of course, exit tax. This question only arises when they both are registered. Now, so we have to assume that they both are registered. Whether they are fulfilling every condition, right answer is we can assume that they are of the same purpose and exit tax would not be applicable in this case. Simple point it was. No issue with this question at all. Okay, so continuing further, question number 15, what it says. In respect of following independent case scenarios, you have to discuss whether TDS would be applicable or not. Simple. Mr. Ramesh is the distributor of the lottery tickets in Mumbai for Golden Lottery Agency. See, Golden Lottery Agency is a company for which Ramesh is a distributor. See, Ramesh distributes lottery tickets on behalf of this company. So Ramesh would be getting commission, and for this commission, TDS under section 194G would be applicable. That would be the basic of the question that I'm telling. Okay. Very old lottery existing since 1975. It has turnover of 98 lakh rupees. See, under 194 GA now, this turnover limit is not relevant. Turnover relevance comes only under hijacker provisions. Under 194 HIJACR is only applicable. Turnover is only applicable for these sections. Under 194G, no turnover is applicable. If I am selling lottery, if I am giving commission for lottery, even for 1 rupee, then I have to deduct TDS. Perfect. For financial year 23-24, Ramesh earned commission 18,000 rupees. See, 18,000 commission on 15/7 and 40,000 on 15/11. Important here is this section undergone amendment under section on 1st October 2024. Any commission received before 1st October 2024 was leviable for TDS at the rate of 5%, and later on this rate was reduced to 2%. So earlier TDS was to be deducted at the rate of 5%. Later on, TDS was required to be deducted at the rate of 2% only. Simple point this was. This is a good question. This is also a good question. This is also, well, last question was also based on amendment. This is not based on amendment, but more on intellect, I should say. See, Smart Watch Private Limited is emerging fintech based startup used in Bangalore. Smart Switch Private Limited SSPL is fintech based startup, no issue. Operates a digital platform for trading in various cryptocurrencies, no issue. The company has recently gained popularity among young investors due to user-friendly app and attractive promotional offers. Everything crap till now. On 1st November, Mr. Adesh, IT professional Gurgaon invested 1 lakh rupees. Adesh, 1st November 2024, invested 1 lakh rupees in Picto coins, a cryptocurrencies. Okay. On 15th December, he sold. On 15th December, he sold and earned a profit of 347,504. See, nothing relevant in this question. What you need to understand is just you have to answer the TDS provision. This crypto platform is required to deduct a TDS while making payment to this seller under section 194S. Under section 194S, this crypto platform has to deduct TDS at the rate of 1% under section 194A while making payment to this seller. Important point here is how much TDS? Sir, how much TDS? TDS is deducted on sales consideration. 1% on sales consideration, and 1 lakh was purchase price. 3,47,504 was the profit. That means sales consideration was 447,504, and adding this, TDS has to be deducted on 447,504. TDS has to be deducted on this amount also. Important point I'm telling, I'm not just joking, this is important. Take care. We got this point, sir. We got this point to the fullest. That means TDS is to be deducted at the rate of 1% on 447,504. That means 4,475 is the amount of TDS to be deducted. No issue. This is the amount of TDS to be deducted. Question number 16. What it says. Assessing officer with prior approval of the Principal Commissioner of Income Tax. Assessing officer with prior approval of Principal Commissioner of Income Tax directed Messrs Greenfield Textiles to get their books of accounts audited under section 142 2A under Income Tax Act. Greenfield Private Limited is the company against which audit under section 142 2A was done. Perfect. On account of complexity of the accounts, the reason is valid. Assessing officer cannot understand books of accounts, therefore he wants special audit to be done. He wants chartered accountant to furnish report. For this purpose, chartered accountant was nominated by Principal Commissioner of Income Tax. Principal Commissioner of Income Tax nominated the chartered accountant. Say a CA firm XYZ was appointed to carry out the audit. The SSC was willing to produce books of accounts. SSC was very good. SSC was willing to produce books. He extended full cooperation and getting audit conducted. However, nominated chartered accountant, this bad chartered accountant, without any valid reason, refused to undertake the audit. Without any reason, he did not do audit. He refused to do the audit. Because of which, assessing officer treated this SSC as defaulter and conducted best judgment assessment. Whether assessing officer, in line with the provisions and judicial judgments, you have to identify whether assessing officer did correct or not. See, what the question is, understand this. SSC wants to get books of accounts audited. SSC agrees. SSC is willing. SSC is cooperating. Everything that SSC can do, he is doing. But a chartered accountant who was supposed to do the special audit is not doing it. What should SSC do? Whether SSC should be liable for best judgment assessment? Right answer is no. SSC should not be held liable for best judgment assessment. Why, sir? Because it is not the issue with the SSC. It is issue with the chartered accountant. So what ideal case should be? This chartered accountant should be removed and new chartered accountant should be appointed so that special audit can be done. But in no case, SSC should be held accountable for best judgment assessment. Let me show you how answer is written in this case. Let me take you through the answer, what they want you to answer. First of all, they are asking that whenever assessing officer feels that books are complex and he requires books of accounts to get audited, he can ask the case to Principal Commissioner. Principal Commissioner would appoint chartered accountant, and SSC has to get books of accounts audited whenever chartered accountant is appointed. Also, on account of failure by the SSC would be liable for best judgment assessment. This is the legal provision. In the present case, a chartered accountant was appointed. He did not do. He was wrong. So in that case, best judgment assessment was done for the SSC, against the SSC. This was evidence in Swadeshi Politics Limited versus ITO in case of Supreme Court that if it is not the issue with the SSC did not do any wrong. So in that case, why SSC should be penalized? So SSC would not be penalized. It is the chartered accountant who did something wrong. So he should be penalized for that case. Therefore, action of assessing officer is not valid. Question number 17. I don't know how many times I have done this question. Literally, I don't know how many times I have done this question. Very simple question. See, it is on account of underreporting or misreporting. Sunrise Trading Company, a partnership firm engaged in the wholesale trading of electronics, filed the return of income for assessment year 25 declaring total income of 40 lakh rupees. Assessee, he has declared the income of 40 lakh rupees. Declared income 42 lakh, 40 lakh. While processing, this income was increased to 42. See, whenever income is enhanced on account of processing of return, this never amounts to underreporting or misreporting. Whenever income is enhanced uh, on account of this processing of return, it is no underreporting, it is no misreporting. But whenever this income is increased on account of scrutiny assessment, see, on scrutiny assessment, this income increased by 16 lakh rupees. So the 16 lakh would be taxed at the rate of 30% plus 4% education cess. And this increased income, whatever taxes arise on this increased income, would be penalized with 50% or 200%, whatever the case may be. If it is underreporting, 50%, if it is misreporting, 200%. 16 lakh into 30% into 1.04. All in all, 499 200. This is the amount of tax to be levied. Now penalty, how much should be levied? It depends upon case. Now what it says, on scrutiny, the assessing officer determined the total income of 58 lakh rupees by making CK. It is not on account of misreporting. That means 200% penalty would not be applicable. 50% penalty would be applicable. Perfect. Assessing officer satisfied that underreporting and he initiated the proceedings. You are required to compute the penalty amount. We calculated 50% would be 249,600. 249,600 is the penalty amount. Whether Sunrise can file an application for grant of immunity for imposition of penalty and specify the conditions. See, grant of immunity is different from grant of prosecution. Whatever the compounding of offences guideline you have studied, that is different matter. Here we are asking immunity for the penalty. Whatever penalty has been imposed to us, we have reasonable cause of failure. We have reason to not pay penalty. So we are just showing that. Now, what happens is, it is important to know that grant for immunity for the penalty is only allowed against underreporting. If you have done misreporting, no immunity would be granted. Only for underreporting, you are granted immunity, first of all. Second thing, like the video if you have not liked the video. Matarani will not bless you if you have not liked the video till now. Focus. If liked, subscribe also. Okay. What we are saying. First of all, immunity would not be granted in case of misreporting. It will be only granted in case of underreporting. Second thing, you have to pay the taxes. You don't have to file the appeal. You have to apply for immunity, and immunity would be given to you. As soon as order is being given to you, within end of that month, within 1 month, you have to apply for immunity. You will be given immunity, no issue whatsoever. If you have reasonable cause of failure, just apply to you and you will be given immunity in that case. No issue whatsoever. Sir, no issue. Next question. Now what do we have? What do we have? Delta Global Limited, a foreign company, operates a branch in India. See, a foreign company, Delta Global Limited Inc., is a foreign company who has a branch in India. Okay. For the financial year, head office expenses administration now allocated 1 crore 85 lakh. 1 crore 85 lakh rupees as head office expenses. Oh my god. The adjusted total income is a loss. Adjusted total income is a loss. The assessable total income and other details for the 3 years. See, how much head office expenses for a branch is allowed, that is told by section 44C. 44C is that actual head office expenses that have been allocated, that is 1 crore 85 lakh, that can be used, or 5% of adjusted total income. Either of two, whichever is lower will be allowed to. Whichever is lower shall be allowed to you. Sir, no issue. We understood your point. Now, in this point, important here is what is adjusted total income. In our case, adjusted total income is given to us, which is a loss, and we are aware that if adjusted income is loss, adjusted total income is a loss, we have to take average of last 3 years. Whatever the average of last 3 years turns out to be, we have to take that. Now, how do we compute? We have to compute ATI for all the 3 years. Now, how do we compute ATI? We have a specific formula. Now, what is the formula for that? Whatever the assessed income is, you have to add 5 things to it. 5 things. What are those 5 things? See, what are those 5 things? God bless me for this. After scientific research, Buffalo उड़ गई and took deduction for head office expenses. What did I just say? After scientific expenditure, Buffalo ud gayi and took deduction for head office expenses. What did I just say? Scientific expenditure, if any debited, add back. If you have any kind of Buffalo means brought forward losses. Brought forward imply brought forward, not current year. Only brought forward losses to be added. Okay, sir. If you have taken deduction of any unabsorbed depreciation, add back. If did I say current year depreciation? No. Did I say current year loss? No. Only brought forward losses, brought forward depreciation to be added. Sir, any chapter 6 deduction taken, add back. Any head office expenses debited, add back. Sir, what things to be added? Sir, assessable income, assessable income, assessable income. Do we have to add current year depreciation? No. Unabsorbed depreciation, add. Chapter 6 say add. Brought forward loss, short term loss, add. Long term loss, no, because this is current year loss. Speculative loss, add. VRS, no. Head office expenses, yes. Add these, you will arrive at head office expenses. If you do the total of these, you would arrive at 2 crore rupees. Similarly, you will arrive head office expenses for this, ATI for this, and you will arrive ATI for all the 3 years. Add all those 3 ATIs, divide by 3, you will arrive the adjusted average total income. Take 5%, you will get the head office expenses. Let me show you how they have done. Whatever I have told you now, they have done the same. Calculated ATI for all 3 years, divided by 3, arrived at ATI, and of this ATI, they took 5%, and that is the amount of eligible head office expenses that they are allowed as deduction. Question number 19. Important, good question. Another good question. What did it just say? Examine whether the following transaction and following the transaction and whether whether the transfer prices declared by the following SSC who have exercised the valid option of exercising the safe harbor can be accepted by the income tax authorities or not. See what this point is all about. Under section 92 CV, we have safe harbor rules. Now, up to September 25, now only one safe harbor rule was announced, but for Jan 26, nearly 10 safe harbor rules have been announced, and for that entire English amendment statutory videos, amendment videos has been uploaded on YouTube, this channel only. Sir, in that safe harbor rules, mostly what happens is 17%, 18%, or 24% is to be declared by the SSC. Where 17%, where 18%, where 24%, that is subjective matter, but that has been discussed in the video. You will understand, you will learn, even you will be able to learn it if you watch that 1 hour video. Now in this question, whatever relevant amendments are, I will tell you that only. What it says. Tech Mitra Solutions is an Indian company, provides the services related to support system to Orbit, in which it holds 30%. See, we have Orbit, named company Blue Orbit. It holds 30% in Tech Mitra. Now, Tech Mitra and Blue Orbit are associated enterprise. Whenever Indian entity gives any of the software development services to associate enterprise, this Indian entity can declare if transaction is up to 100 crore, then it can declare 17% as their profits. If transaction is up to 300 crore, then it can declare 18%. If transaction exceeds 300 crore, then no safe harbor rules are allowed. In our case, transaction is 99 crore. That means this Indian entity, this Tech Mitra, should at least offer 17%. Now, out of this 50 crore expense, it is offering 8 crore as operating profit. That means nearly can have 16%. It should have declared 17%, but it is declaring 16% now. So in that case, safe harbor rules will not be accepted by the SSC department. The department will not accept this. Department will proceed with TPO. Department will proceed with calculation of ALP. Next, era systems. Provision for processing services. See, processing services with the use of information technology is nothing but IT enabled services. In case of IT enabled services, also what happens is if you are providing it to any of your associate, then you have to offer 17%, 18%. 17% if your total income is if your transaction is up to 100 crore. If transaction is up to 300 crore, then in that case you have to offer 18%. So transaction is 265 crore. In this case, we have to offer 18%. Now, they are offering 45 crore out of 225. That means they are offering 20%. That means their safe harbor rules can be accepted, validly accepted. We are offering 18%. We are offering 20%, Raj. Instead of just 18%, so safe harbor rules are absolutely allowed. Pragati and Company, a partnership firm registered under the Partnership Act. It is providing R&D services to a firm in which 12% interests are being held. See what it says. If foreign entity holds 10% profit or 12% profit sharing ratio in Pragati Company, See, are they associate? See, for partnership firm, na, we don't have to say 26% criteria. Partnership firm criteria is 10% only. Only if they hold 10% in our partnership firm, or if our partnership firm holds 10% in any other entity, in any other partnership firm, then they are associate only. In firms, we don't have 26% criteria, rather 10% is to be checked. So these are associate. And since they are involved in research and development, for research and development, we have to check whether transaction between them is up to 300 crore. If it is up to 300 crore, then 24% is to be offered. If it is beyond 300 crore, no safe harbor rules are allowed. In this case, since 175 crore, so 24% is to be offered. It is offering 50 by 250. That means it is offering 20%. That means safe harbor rules are not exercised. A department is going to question this point and they are going to calculate the ALP. Whatever I have said, it is reflected in the answer. Would your answer change? Acha, would your answer change? If foreign entity is located in notified jurisdictional area, if any of the foreign entity is located in notified jurisdictional area, answer would change. Yes, no safe harbor rules is allowed in case of say no, in J. If you are transacting with any of your associate enterprise under which is under notified jurisdictional area, then no safe harbor rules are allowed to you. Got it, sir. Question number 20. Very simple question. It is very simple question. Miss Ritika, age 30, a resident individual, started the business of printing mobile skins and covers in India and abroad. She frequently visits country Z to serve her overseas clients. Okay, perfect. The following particulars are furnished. Receipt from sale of mobile skins. See, in India, she sold mobile skins of 12 crore 45 lakh 50,780. And in country Z, she sold 15 lakh 50,000. No issue. Business income. Expenses for earning. See, in India, we are always allowed deduction of this incomes. Of this income, we are always allowed. How much we did? 10 crore 20 lakh. Perfect. And in country Z, we are allowed deduction. Yes, of course. In India, we are allowed deduction for that business expenditure. Rent received from the commercial property in country Z. So 60,000 rupees is the rent received. We have to take 12 months, and in India, only 70% of the rent is taxable. So how much amount turns out to be? 546,103. This is the amount of rent that would be taxable in India. Expenses. See, whatever rent in expenditure is incurred for earning the rental income is not allowed in India. It might be allowed in that country, but right now it is not allowed. So we don't have to consider that. Country Z, we have flat tax rate of 25%. So foreign tax rate is clear to us, 25%. Very simple point. During business expansion for financial year 24-25, Miss Ritika expanded her mobile accessories by opening a large manufacturing unit in Pune. For that matter, she hired new employees. 18 employees were hired on 1st May 2024. That means she hired them for 11 months by paying salary of 23,300. Again, she hired 22 employees on 1st June 2024 by paying salary of 24,500. That means 22 employees paid for 10 months at the rate of 24,500. Again, she hired 15 employees on 1st November 2024. That means 15 employees for 5 months by paying salary of 24,700. All the employees participated in recognized provident fund. Such expenses have been considered while considering the business. See, these business expenses that we have taken now, business expenses include the salary payments. Perfect. India does not have deductible with that country. Ritika is paying as per default regime. You are required to compute the total income and net tax liability, and that is the question. That is the question. First of all, sir, if you are hiring new employees, whether it is old regime or new regime, you are allowed deduction. And second thing, deduction on these employees would not be allowed because these are not employed for 240 days. So how much deduction? Take out the employee cost, multiply 30% to it, and that would be the amount of deduction under section 80JJAA. 18 employees for 11 months into 23,300 first. Second, 22 employees for 10 months into 24,500. This would be take that plus into 30%. Amount of deduction would be 30 lakh 1,020 rupees. This is the amount of deduction under 80JJAA would be allowed. Now, whenever you have to solve this question, now this question has to be solved under 5 steps. First step is total income as per Indian tax laws. Indian tax laws. First step is total income. Calculate total income. See, for total income, we have to calculate na business income now. So 12, 45, 57, 50 minus 780 minus 10 crore 20 lakh. So it would be 2255075 22550 and 6,50,000. Whatever things I'm highlighting in blue, now just add them down. And whatever things I'm highlighting in red, just reduce it down. So our total income would be 207,45760. This would be our total income. No issue, sir. No issue. Absolutely no issue. Second step would be calculating tax liability. Now, what would be the tax liability on this 2 crore? We have to take the slab rate up to 3 lakh, no tax rate to 7 lakh, 5%, 7 lakh to 10 lakh, 10%, 10 lakh to 12 lakh, 15%, 12 lakh to 15 lakh, 30%, up 20%. Exceeding 15 lakh, we have to take 30%. And if income exceeds 2 crore, then we have to have 25% surcharge also. So tax liability would turn out to be 207,45750. 760. Tax liability would turn out to be minus 15 lakh into 30% plus 1 lakh 40,000 into 1.25 into 1.04 or divide by 1.04. See, tax liability before cess. Before cess, tax liability is nothing but 73, 92, 160. Do you remember our first class? Very first class where I told you that I'm asking a pinky promise from all of you. Whenever we calculate figure, which is we calculate taxes on income, which is near to a surcharge bracket, you have to consider marginal relief. This question specifically aims you to focus on that area. How marginal relief is calculated? Calculate tax plus surcharge on 2 crore. Surcharge would be 15% applicable now. Plus surrender whatever the income over and above is 7,45,000 has to be surrendered. Whatever the income over and above 2 crore is. Now, how much tax would be arrived? 2 crore minus 15 lakh into 30% plus 1,40,000 into 1.15% plus 745,760. Now, this would be the amount of tax to be paid after considering the marginal relief. 728,960. This is the amount of tax to be paid. Now, add 4% education cess to it. 7. Tax liability would be 75,8830. This would be the tax liability that we will arise. Third step would involve us to calculate average rate of tax, which would include tax liability divided by total income. 207,45760. 36.5416%. Fourth step, foreign tax rate 25%. Whichever is lower, take 25%. Fifth step, calculate doubly tax income. What is the doubly tax income? Important point. What is the doubly tax income, sir? Business income, since 6,50,000, it is 650. 6,50,000 is the business income that is being taxed there, and the same amount is taxed here. That means this is the doubly tax income. Yes. For rentals, India is taxing house property at 5,46,000. But in that country, how much rental is taxable? 780 minus 1,50,000 deduction. That means they are taxing at 6,30,000 rupees. So doubly tax income would be lower of them. That means 546 would be added to doubly tax income. So actual doubly tax income would turn out to be 650 plus 546 with would be 11,96,000. So doubly tax income would be 11,96,000, and our relief amount would be 1196 multiplied by 25%. That would be 2,99,000 would be relief amount. This is the solution. Let me show you the answer. This is the amount of answer, and that is what completes your entire topic. I hope you understood the topic. I hope you enjoyed this RTP discussion. I hope you liked the video. You subscribe to the channel because it is a humble request. The level of effort that I'm putting in this is really beyond my limits. And if you want more such content, do motivate me by subscribing to the channel. Do motivate me by sharing it with your friends. Bye bye. Take care and enjoy studying. See you all guys in some other video.